In last video we discussed about the present worth method. About the present worth method. So in the present worth method, that value or worth value we calculated at the beginning of the planning horizon. At the beginning of the planning horizon. Similarly, you can calculate future worth method. In the future worth method, you calculate this particular worth, at the end of the planning horizon. At the end of the planning horizon. So this future worth is nothing but the that particular equivalent to the worth of cash inflow and outflow at the end of the planning horizon. So we calculate or consider this worth value. At the end of the period. So, and in present worth method, we calculate this particular equivalent worth at the beginning of that period. At the beginning of that period of that particular considering considerable period or planning horizon. At that considerable period or the planning horizon. So in this future worth method, we consider or we calculate that equivalent worth value for the particular inflow and outflow of that cash at the end of that particular period. With some interest rate. That is we consider as a or called as a minimum attractive rate of return. So this is the main objective of this time value of money is to maximize this future wealth of a firm or organization. So this we can calculate with this formula. So this future worth we can calculate with this formula. So this formula is a written like this: fk into bracket 1 plus I raised to n minus k, and this summation we consider from k equal to 0 to the n. So k is the period for which we have to calculate that future worth, and this n is the number of that compounding period. In the planning horizon. So I is the effective rate. I is the effective rate, interest rate, which we called as a minimum attractive rate of return. And this FK is nothing but the future cash flow at the end of the period K. Future is the future cash flow at the end of the period K. So with this formula, we can calculate this future worth value. At a particular period K, at the end of that particular period value K. So if this future worth is greater than or equal to 0, then this project we can consider as economically justified. So with this formula, we go through one numerical and then we move further to the next method. So in the second example, in which the space heating system is considered, with minimum attractive rate of 15%, with some salvage value, with some initial investment that are given in this particular example, and we find out the present worth value in this numerical. Same numerical or same system we consider for this future worth method numerical. So here same system is considered for this example, and the saving, but only changes are the savings in the electricity bill from the space heating system that cost rupees 1 lakh rupees in purchase, and install. They are projected to be 20,000 per year. So here it is given that initial investment is 1 lakh. For the particular system, and that saving in electricity bill is given as 20,000 per year. So in this sentence it is given that initial investment is 1 lakh rupees and saving in that electricity bill is 20,000 per year, and the system market value after 15 years is estimated to be 20,000. So salvage value is given as 20,000. They ask to find out the future worth value by using the future worth method. Determine whether the purchase of this equivalent would be justified. would be justified. And this minimum attractive rate is given as the company is currently using minimum attractive rate of return is 18%. So this same system is considered that we discussed in the present worth value method example, but here that interest rates, initial investment and the electricity bill saving are changed. These values are changed in this numerical. These values are, and they are asked to calculate. They are asked to calculate future worth method, future worth value, and accordingly you justify whether this project is a desirable or undesirable. So we find out that future worth value. So initial investment given is a 1 lakh rupees. Annual revenue AR, electricity bill, the savings in electricity bill, this is considered the annual revenue, which is considered as 20,000. Salvage value is given as a 20,000. Minimum attractive rate of return is given as 18%. So future worth value we consider as a minus 1 lakh rupees. Minus 1 lakh rupees, it is an investment that we discussed in that cash flow diagram of the first numerical. Cash flow diagram of the first numerical. So here this is the particular investment. This is the cash flow diagram. This is the cash flow diagram. This is the particular investment which is considered negative, and that are savings are considered as a positive. Saving for each year that are considered positive. In our example, this saving is given as a 20,000. Saving is given as a 20,000 for particular years, and 1 lakh is the investment. Consider that similar cash flow diagram. So investment is considered as a negative. Investment considered as a negative, minus 1 lakh rupees, and this FP and FA, these are the single payment value for a particular, this FP single payment value for a particular compound interest, and this is a uniform series value for a particular compound interest. So FP and FA are the single payment value for the particular compound interest, and FA is the uniform series value or particular uniform series amount for a particular compound interest. So, and that we calculated with this formula. 1 plus I raised to n, and f by a we can calculate as a 1 plus I raised to n minus 1 divided by I. So with this formula we can calculate this particular factor, and that are considered as this is the single payment compound amount, and this is the annual payment compound amount. Single payment compound amount and the annual payment compound amount that we calculated by this factor. Value is considered as 15. So 15 year that are considered. So 15 yen is 15, I value is 18%. So by substituting that value in particular factor, and we calculate this particular factor as a 11.97, and this annual value, amount, uniform series annual amount, we can calculate as a 60.96. This is the annual uniform series annual compound value. So this we calculate as 16.96 plus 20,000 is the salvage value. So this value comes as a 41,936, which is greater than 0. So we can if that future worth value is equal to or greater than 0, then this project we can consider as a desirable one. So here that value comes as a greater than 0, so we can consider that it is a desirable to invest. So in this future worth method, we consider that future worth for a particular period of time, at the particular end of period of time, with a particular investment and with particular annual revenue, So next we move toward the annual worth method. So we discuss the present worth method, future worth method. Now we discuss the annual worth method. So these methods now here in this particular unit we consider to justify that project, or we can consider it is a evaluation process. For a particular project, whether this project is desirable or undesirable with the given situations, with that given investment, with that given expenses value. So with considering all this element, we can justify this project is a justificable or not justificable. So in this unit we evaluate particular project. By considering these methods. And in next unit we discuss about the comparison. of this all method. Regarding this project evaluation. All this method regarding this project evaluation. So that we can consider are called as a project alternative. So these are the methods we discuss now. Present worth method, future worth method. Now we discuss annual worth method. So in this annual worth of that particular project, so here that this is related to the annual series of amount. For a particular period of time, and that consider with a minimum attractive rate of return, or with a particular interest rate, we consider, and that are considered for a particular inflow and outflow of that cash flow, for this for particular annual series amount, we can consider this as a annual worth. So annual worth is nothing but it is a annual series of amount. With a particular interest rate, which we consider as a minimum attractive rate of return, and that we consider for a particular period of time. And for particular inflow and outflow of that particular cash. So this annual worth of this project. In this annual worth of project, we consider annual revenue, annual expenses, and capital recovery amount for a particular period. So in this calculating this annual worth, we can consider annual revenue, annual expenses, and capital recovery for annual capital recovery. So these are calculated for a particular period n. And this we can write mathematically. As annual worth is equal to annual revenue minus annual cost minus annual capital recovery. And this term we can consider E and CR, annual expenses and capital recovery. These two terms combinedly we can consider as a equivalent uniform annual cost. EUAC, equivalent uniform annual cost. This term E and CR, these are the cost values. So we can consider this as a equivalent uniform annual cost values, EUAC. So these are the equivalent uniform annual cost value. So if this annual worth is greater than or equal to 0, then the project is economically justified. So this capital recovery amount for a period is equivalent to uniform annual cost of invested capital. Is equivalent to uniform cost of the equivalent to uniform annual cost of that particular invested capital, and this annual amount we can consider, as a loss in that asset value, and interest on that invested capital. We consider this year we can consider two terms: loss in that asset value and interest on that invested capital. So CR here consider this capital recovery considered as a initial investment. This is the initial investment. This is considered as a capital recovery. This AP represent as a capital recovery, and AF represent as a sinking fund. AF represents sinking fund, and A by P represent as a capital recovery. Capital recovery for a particular period of time. N. So this A by P represent capital recovery. This A by F represent the sinking fund. A by F represents sinking fund. So these factors we can calculate it by with the above formula given in that particular table. So this is capital recovery. This capital recovery consider a loss in that particular asset value and that interest on that invested capital. Now we go through some examples. Here there is some examples on that based on the annual worth method. So in this annual worth method, this example is given: an asset with an expected life of 5 years is to be purchased for rupees 36,000, and that annual revenue is estimated and rupees 12,000, with an annual expenses of rupees 2,000 at the end of the 5th year. The asset is expected to be sold for 5,000, whereas rupees 4,000 will be paid as a logistic expenses. The interest rate is given as a 10% compound annually. By using the annual worth method, determine whether the asset should be purchased or not. So here in this example, 36,000 is a principal amount which are invested on that particular asset. Annual revenue is 12,000. Annual expenses given as a 2,000, and salvage value is given as a 5,000. But again, for the salvage value, 4,000 is the cost, logistical cost. So this 5,000 minus 4,000 is the salvage value. So the salvage value considered as a 5,000 minus 4,000, and a year particular period of time is considered as a 5 year. 5 year is given 5 years. That particular period of time is given again as a 5 years, and minimum attractive rate is given as a 10%. So this annual worth we can calculate it by formula. As a like this. We calculate with this formula like this. So this is annual return or annual recovery. This is the annual revenue minus annual expenses plus salvage value, and this factor is related to the capital recovery. So with this formula we can find out this annual worth. Put all these values. So this capital recovery and the sinking fund value. We can calculate it with these two factors. Annual revenue is 12,000. Annual expense is given as 2,000. That value we can directly put. Salvage value is given as 5,000 minus 4,000. Principal investment is 36,000. Only these factors, capital recovery and the sinking fund factor we can calculate it with this above table. Capital recovery and sinking fund factor we can calculate it by this formula. I into 1 plus I raised to n divided by 1 plus I raised to n minus 1. These formulas we discussed in the time value of money chapter. These are discussed in time earlier money chapter. How these factors are come, and that derivation we already discussed in that particular time earlier money chapter. So these factors we used directly in this example, and these are called as a capital recovery, and A by F is a sinking point. A by F is a sinking point. So put these value of AF and AP. Put this value of AF and AP, and these factors are calculated as a 0.26 and 0.1638. So this, after this simplification of all this equation, this value comes as a 667. So this value is greater than 0. This value is greater than 0. So the purchase of that asset is desirable. Purchase of asset is desirable. So we move now further for the next example. For the next example.